Well, good afternoon, students, and welcome back to Principles of Financial Accounting, the first class. We now take up Lesson 5, Accounting for Long-Term Assets and Liabilities and Payroll, Short-Term Liabilities. Let's take a look at these. Chapter 8, Long-Term Assets are treated differently as they are consumed than short-term assets. A short-term asset is basically expensed. That is, supplies would be a good example. We purchase supplies, and as we use them up, we count them as being expended, and we record the expense, which reduces our revenue. With a long-term asset, however, the expensing, so to speak, occurs over multiple accounting periods. So what we want to do here is we want to set aside a separate account called a contra account, depreciation expense, which is an estimate of the rate at which the asset will be consumed until it is no longer useful. The useful life of a long-term asset can be several years. A good example would be a pickup truck. A truck will be purchased and used up over a course of, say, 5 years. Each year, then, we would subtract 20% of the cost of that truck in the form of expense, but the expense is not taken directly from the asset account, the value of the truck. Rather, it's recorded in a separate account called depreciation. The reason we do this is depreciation is an estimate only, and it is subject to adjustment as time passes. If the resource is plant or equipment, we use the term depreciation. However, other long-term assets, we use slightly different nomenclature. If we're talking about natural resources, for example, natural gas or oil, we refer to the using up of that resource as depletion rather than depreciation. And if the asset is intangible, for example, a patent, then we use what's called amortization. Amortization, the gradual loss of value of the patent until after 20 years it no longer has any value at all. Depreciation can be for land, by the way. There is no depreciation. Land does not depreciate, so we don't set up an account to measure that expense. Since depreciation is an expense but not a cash flow, it has a profound effect on taxes. Basically, the more depreciation a firm can generate, the lower the taxes they will pay in the current time period. That is, those taxes will eventually be paid, but they'll be deferred. And a tax deferred is an advantage because the money that might otherwise go to paying that tax can be used to generate profits, more or less interest-free, so to speak. So, and incidentally, tax preparation does not invoke the matching principle. Taxes, we just simply want to pay the minimum taxes possible each accounting cycle, knowing full well we'll pay the entire amount as time passes. There are different methods of depreciation. I illustrated our first example of the truck with what's called straight line, which is divide the useful life of the asset by the number of years, or divide the price of the asset by the number of years it's planned to be in use. If the asset has what's called a salvage value, that is, at the end of the write-off there is still a marketable value and this asset can be sold to someone else, that salvage value is subtracted from the initial price in calculating the depreciation. In no instance can we depreciate an asset for more than its purchase price. Chapter 9 brings up the accounting for liabilities, which would be accounts payable and notes payable, short-term liabilities. Next chapter will deal with the long-term, which is slightly different. And payroll. With regard to notes and other payables, we also want to take a look at contingent liabilities. Contingent liability is something like a warranty where the cost depends on some other activity. Sales, in this case, out of a certain amount of sales, will have a certain amount of warranty work, and so that has to be estimated and set aside in a separate account so that as warranty work is required, that can be performed out of that account. Also, we have contingent liabilities, other contingent liabilities, for instance, a court case that is likely to go against the company. That liability has to be recognized in the financial statements as long as it is probable or near certain, depending, and we'll take a look at some of the various conditions and responses there in this chapter. We distinguish contingent liabilities from general uncertainties. A general uncertainty is something that nobody knows what's going to happen, state of the economy, future interest rates, those sorts of things. Those are general business uncertainties that we all live with and need not be recognized in the financial statements. Finally, Chapter 9 deals with the issue of liquidity versus the issue of solvency. And here again, liquidity is short-term measure of the ability to pay bills in the current year, and solvency is the long-term ability of the firm to pay its bills, interest, and so forth over multiple periods of time. So the only difference between those two is one is short run, one is long run. Okay. Finally, I want to direct your attention to the final exams and homework. We are working towards a goal of 1,200 points, being a perfect score. That's 150 points per chapter times the 8 chapters. The quizzes are worth twice as much as the homework, so I want you to pay twice as much attention to those because they'll make the greatest difference. If you're shooting for a C or better, you want to take 70% of 1,200 as your target for total points, and keep track of how you're proceeding. If you want a higher grade, it's very easy to calculate what your target scores should be. But it's easiest to get the test scores complete. I have begun to remove all of the comprehensive problems from the homework. They are not necessary to further understanding at this point, so we'll do the exercises and problems in the discussion questions, not including the comprehensive problem, which I will begin to remove, and starting with this chapter, lesson 5, or this lesson and the subsequent lessons. Hope you're doing well. You're up to this point. I'm very pleased. Everyone seems to be well motivated and getting the job done. We'll try to keep the amount of work reasonable without sacrificing your progress and advancement in this most important subject, counting the language of business. Thank you very much.